Good morning. Today is Wednesday, June 29th. Thanks for joining us today. We're going to actually call an audible and start off with Bed Bath & Beyond. I remember talking to these guys in 2014, 2015. I wasn't even at Narwhal yet. I talked to the investor relations team. This is when they had the co-CEOs who were both in their mid 80s, and the whole board had been there for 30 years. And I remember talking to them because they had been struggling with same store sales and actually growing the business, and the arrogance that they had and how they approached the market was just unbelievable to me. They basically told me, look, we get what Wall Street's saying. We've been doing this 30 years and we've done quite well, and we don't need to change. And it's like, okay, that's great. But the guys who started it are in their 80s. They probably haven't shopped online much. They don't know what the retail market's turning into. They don't understand the consumer. The marketing is poor. You have a lot of debt. And we were looking at it as a value play to buy it. And we ended up passing. And thank goodness we did pass, because it has not done well since that time. And you've had momentary spikes. There was that short squeeze, I think maybe last year, where the stock really went up when people thought that it was going to be saved, but it is circling the drain in a big time right now. They just reported the first fiscal quarter of 2022, which ended in May. Their revenue missed estimates a little bit, came in at negative 23% over the prior year versus an estimate of 19%. There was going to be some tough comparisons because of the stimulus checks from last year, but they talked about a rapid shift in consumer spending patterns, a declining demand in the home sector. Gross margin came in at 23.8%. The estimate was for 32%. If you're making less than a 30% gross margin, that is not a good thing. They were expected to lose $1.33 per share. They lost $2.83. Their stock trades at $6.53, and they just lost almost $3 in a quarter. Their cash from operations was negative $400 million. They're down to $100 million in cash on their balance sheet. They still have $1.4 billion of debt. Their current ratio, which is their current assets divided by the current liabilities, is only 1 times, which means, and most of that, the vast majority, about 80% of that, is in inventory, which I'm sure is going to be marked down extremely aggressively. So your current ratio, certainly next quarter, is going to be less than 1, which means you're not going to be able to pay your lease payments. You're not going to be able to pay your employees. There's a massive liquidity issue, and they can't raise debt because they already have too much debt. They just changed the CEO today to a board member. They fired the old guy. They are expecting an improvement in the second half of the fiscal year. Tom, I don't know about you. We talked about Beyond Meat convertibles yesterday. That's a company where you're pretty high in the capital structure. You have an asset base that you actually could take hold of, and the bonds are trading at 38 cents on a dollar. That's one where a reasonable person could take a business risk and purchase that bond. I wouldn't touch Bed Bath & Beyond and get even close to that right now.
I think Bed Bath & Beyond is officially taking the crown of the next big company that will go bankrupt. The crown was initially held by Radio Shack, and passed the crown on to Toys R Us, passed it on to JCPenney, and I think that Bed Bath & Beyond is the next one. And there's definitely a trend in terms of what those companies are, which is dinosaur retailers that have hyper-specific a retail focus. You know, Radio Shack was batteries, and I mean, I don't know, little like remote control cars, I guess, was their bread and butter. You know, Toys R Us was toys, and JCPenney was just the world's worst department store. And Bed Bath & Beyond, I think, is taking that crown. And so, I mean, you know, we talked about it a little bit before the call started. This is probably the next major company to go bankrupt. And when these things happen, it can have a systemic effect on a lot of different retailers, because they sell a lot of the same things that Target sells. They sell a lot of the same things that Walmart sells. But the difference is when they go bankrupt, they're going to be, everything goes on clearance, regardless of whether it's a bad product or a good product. You know, I'm going to go in there and buy as many Scrub Daddies as I can, which is the premier Shark Tank based product of the last 10 years. But I mean, it's just a matter of time. But we saw that. I mean, Toys R Us, and it affected. I mean, when Toys R Us went bankrupt, it affected Newell Brands, right? Because Newell Brands was selling a lot of Graco products in Babies R Us. When Sports Authority went bankrupt, it really hurt Under Armour because they sold, they had a big partnership with Under Armour shoes. So these things can have a systemic effect. And so that's something to definitely keep an eye on, is that if Bed Bath & Beyond goes, there are going to be a number of companies, not just retail, that could be really severely affected by that based on how much inventory they've sold, how much they're going to have to take back, rerouting or taking inadvertent discounts on many of their items. People, new sales are going to go down because old sales are going to get eaten up in these clearance sales. So it's definitely something to keep an eye on. But I think that the warning shot has been fired for Bed Bath & Beyond and the systemic risk that could potentially come from that.
I think you bring up a great point about the systemic risk. I mean, you will have gaps in a lot of businesses. And if your business is not robust enough to handle it, if it doesn't have the balance sheet, if you were counting on sales really accelerating this year, you have another thing coming, because you're about to have to take markdowns simply to match Bed Bath & Beyond. And but if you're on the consumer side, if you are a purchaser of home products, this is when you can, you've been being smart, you have some savings, you kind of need to front load some purchases of home products, towels, things like that. This is when you can be the buyer and pick up some of this stuff more cheaply. So that's the positive side. Capitalism works. This was a terrible company. At least the way it's managed its finances. And I think that, this is the way of the world.
This is a second level thinking question, Ben, but do you think that if Bed Bath & Beyond goes under, it's actually positive for inflation because other companies are going to have to cut their prices?
Positive, you mean negative? As inflation
positive
goes
in the
down.
sense that, it could actually affect the prices of a number of consumer goods across the spectrum.
I think there's a firm, and I'll give them a quick shout out here, that we follow fairly closely. It's called Hedgeye. And they've actually called the cycle fairly well. And they're coming out with a macro presentation today. And they're actually talking exactly about that you're seeing inflation begin to turn. You're going to see some higher prints, but we're moving from the inflation piece of it to recession right now. So we're going from stagflation to recession. And they're usually a little bit early, but I think this is an opening salvo in that shift. And I think it's going to be something that we watch very closely. You're going to still see inflation in services. You're going to still see inflation in shelter, and that'll keep the inflation number high. But on the good side, I think that you could see some pretty rapid markdowns in some of these products.
So I think the takeaway for listeners is do not go to Bed Bath & Beyond until they go bankrupt and then go sick, and that'll help inflation. You can do your part.
Yeah, exactly. So let's talk a little bit about what happened yesterday. This is where we were going to start, and then we had the Bed Bath & Beyond news that came out a little bit later after I sent out the notes. But you do have everything that we saw that was good last week, and we talked about the knock-on effects: lower oil, lower rates, lower inflation expectations, higher stock prices. We saw the opposite yesterday. We saw higher oil, we saw higher inflation expectations, we saw higher interest rates, and we saw lower stocks. And that's what's been happening. And we saw what happened with Nike as a result of that. More cost pressure, lower earnings at Nike. You had Intel CEO interviewed. He was quoted as saying it's a turbulent market. All these issues are blowing through the business. So yeah, we think this is going to be a choppy environment for a period of time. And the market's reflecting that isn't particularly surprising. You had the Conference Board come out with their consumer confidence index at 10 a.m. yesterday. Consumers are growing more pessimistic. In fact, right now, more consumers expect their incomes to increase, but only 15.9%. 15.2% actually expect their incomes will decrease in the next 6 months. I thought that was something that was very interesting. And this is actual dollar terms. This is not inflation adjusted, but 15.2% actually expect that incomes will decrease, and only 15.9% expect incomes will increase. Again, Tom, to your point, inflation expectations may be rolling over, but not in a way that's necessarily good for the economy.
I mean, the question is, I don't think a lot of people actually have the option of taking a pay cut to maintain their job, but it's certainly something that maybe companies should be looking into rather than just wholesale firing 10% of their workforce. Say, hey, we'll keep you, but you got to take a 10% haircut. I mean, I would probably take that deal if, the option was being out on the street with no job, especially if I was one of these younger guys who'd come out making a ton of money, probably too much money, take some austerity on the chin rather than some, joblessness.
Well, that's a great point. I mean, how would incomes decrease? One, taking a base pay cut. Two, lower bonuses, which I think we're already seeing at Wall Street. Three, though, losing your job. That's the
income
ultimate
goes to zero.
Income going down. And so with 15% of people thinking that's a warning sign for the economy. We do have some other earnings coming through. McCormick, the spice maker, they reiterated their revenue guide, even with more currency issues. And this is all because of pricing. They're getting more pricing. Problem is their costs are rising even faster than their pricing. So they actually took down their earnings guidance for the year. However, they do expect, and I quote, pricing actions and other levers to begin to outpace cost pressures in the second half of this year and to fully offset the cost pressures over time. So you're still seeing companies deal with the realities of the cost inflation, even while some products like in the home sector are seeing pricing declines. General Mills came out with a good quarter, but again, the cost pressures really hitting the business. They're seeing double-digit inflation on cost of goods sold. They expect volume elasticities to increase but remain below historical levels, which basically means their pricing power is declining. When you see volume elasticities decrease, that means pricing power is declining, which means that companies like General Mills, companies like McCormick, they're still going to raise prices aggressively, but they're not going to have as much leeway to do so as they were maybe even just 3 months ago. Tom, any comments on this and how this impacts the bond market?
I mean, I think all these numbers are pretty in line with where we were expecting, right? Costs are coming up significantly. In terms of the bond market, today we're up a little bit. I think some of that is based more on, we've gotten some European inflation numbers this morning that have come down. Well, kind of depending on where you look. The overall Eurozone, I believe, came in under expectations, with Germany being the flagship there. So, the thing that's interesting though is if you drill deep into the CPI that we got for the Eurozone, is that their core is actually rising significantly. So the core was the expectation was 4.9 and the actual was 5.5. So I think they're seeing that too, right? They're seeing things like
Germany.
This is a Eurozone. As far as I can tell, this is the EU harmonized year over year CPI core. So they're seeing the same things as well, things like wheat, things like food. But the overall number was expected to be 10%. It actually was 8.7. So we're seeing things like, I'm assuming, gas coming down, perhaps down over there, things that aren't necessarily in the core. But I would expect this to continue as we see earnings come out, that prices are rising faster than earnings. We're going to see a lot of write downs. I think that I mean, General Mills is probably doing better than most because odds are people are turning to cereal versus eggs for breakfast, right? And we're getting to the point now where you're getting close to $1 an egg. So you're looking at $3-4 for a full breakfast versus, a box of cereal you can get 4 or 5 breakfasts for $4. And so I think that, some of those companies like General Mills are probably going to do better despite the rising costs. But I mean, it's just tough. But you can see even in the Eurozone, with inflation starting to tick down in terms of their overall numbers, the core is coming up, which means that, some of these basics are going to be continuing to accelerate quickly.
Yeah, I think what we have in inflation is a very interesting dilemma because you saw what happened when the supply chain was relatively okay in 2008. And you saw the big inflationary boom, explosion higher into the summer of 2008. I mean, I think people forget oil was $140 a barrel in the summer of 2008. Gasoline prices at the pump were incredibly high on a relative basis. And then by the end of the year, you saw oil drop from $140 to $40. So when you see this inflationary, blow off top bust, it can go very quickly. And Bed Bath & Beyond is kind of a harbinger of that. What we're seeing maybe in the Eurozone, who doesn't have the same economic strength as the US or even I guess to put it a little bit different, is even more weak than the US. You're starting to see that. And I think that's something we need to be mindful of, and we continue to be mindful of as we look at businesses to purchase. Finally, just finishing off on Europe, did want to mention the NATO buildup. Finland and Sweden are set to join NATO. This comes after Turkey dropped its opposition to that. The U.S. is building up its presence in Poland. They already have 100,000. We already have 100,000 U.S. troops in Europe, but we're going to actually set up a permanent headquarters in Poland for the 5th Army Corps. And then meanwhile, President Zelensky in Ukraine says that, quote, we need $5 billion a month for protection and defense. So this is what's going on in Europe right now. It looks like all the NATO allies are on board with spending a little bit more money and really trying to counter the threat from Russia, which, is probably a good thing to contain Russia. And, we'll have to see what happens with that, but that's definitely going on across the pond. So we'll continue to keep eyes on that. And that could, also keep a floor under the price of oil and gas, which could continue to pressure some of the profits for these companies. Tom, any final thoughts?
The only thing we didn't really note yesterday was there was a 7-year auction that was abysmal. Foreign demand for U.S. Treasuries has dropped significantly. We went from, I think it was 77% of the last 7-year auction went overseas, and it dropped to like 60 or 59% yesterday. It was exceptionally weak. So that seems to be the tide going out on that. I think that people are starting to see value at other places. The demand for treasuries is dropping worldwide in terms of the auctions, and that's going to be pretty negative for rates. Unless something changes, unless rates really significantly come down in places like Spain, Italy, Greece, where there seems to be a little bit of opportunity in terms of just blowout yields. We're probably going to see some weakness there, and you combine that with the fact that inflation expectations are kind of creeping back in. The Fed is really going to start QT in earnest, over the next couple months. I think we're in for a bumpy ride on the bond side, but as soon as a recession potentially hits and the Fed maybe overshoots, then I think rates will come back down. So I think that creates a short-term opportunity for buying bonds, maybe not so much this week, but potentially in the coming weeks. That could really be a benefit long-term, but it's going to be exceptionally volatile, I think, going forward.
Yeah, I agree, Tom. And I think, just for people who are listening to this, what I would say is I want to be clear about where our view is on where the market's, the current market environment, the current inflation environment, the current economic environment. That's one of the goals of the market memo that we're now sending out every Friday. In terms of that, I think we've been pretty clear that we don't think the economy is in a great spot. We think that, we're continuing to move downward, and that we may print a recessionary GDP print this quarter. On the inflation side, it's a little bit more mixed. We may see inflation begin to start coming down, but there's going to be continued support from the oil and gas prices. There's a whole bunch of noise. And so you come in one day and we might be talking about a bad result from Bed Bath & Beyond, and then maybe tomorrow Amazon has a pre-announcement that's positive. Who knows? But the overall tenor, the overall trend is what we're trying to make sure that we stay focused on. We want to talk about the stories of the day, but we also want to make sure that we have context of where we are and where we are in that sine curve of the current economic situation. So with that, we'll let you go. We will be here tomorrow at 8:30. Hope to see you there.